Okay, let's figure out what this auspicious time really means for the markets, though. Sandip Sabharwal here to talk about exactly that. Sandeep, hi, morning. Good to have you on the show. And now it seems that it's going to be global weakness, which is going to perhaps pull us even further down.
Yeah, so I think, at least in the short term, writing is on the wall. Slightly longer term, I think valuations have come back now to more reasonable levels after the frenzy which we saw last year. So large cap valuations are looking better than small and mid cap valuations because both the indices have fallen almost similarly from the top, and the valuation on small and mid cap had run up very substantially. So I think the trend in terms of how well India will do vis-a-vis the rest of the world, etc., will depend on monetary policy, fiscal policy, etc., where we'll have a lot of clarity over the next 2, 3 weeks. But I think the corrective move is fine. I don't see it as a big threat in terms of the overall bull market ending because those indications don't seem to be there. So these sort of valuation corrections happen at periodic intervals, and that's something which is happening now.
Which is healthy also, I guess, for a pretty much one-way bull market up until now. But Sandeep, other than that, what's your list like? And would you be looking to add positions anywhere or make fresh purchases in this current decline?
So I think as the result season plays out, then we'll get a more fairer idea of how various companies and sectors stand. But the decline in the rupee obviously will help the exporters. To that extent, export-oriented companies, IT, pharma, many other companies which have reasonable export presence and were getting hurt because of the unnatural strength of the rupee, those could benefit. The other companies which could potentially benefit just because of the valuation correction would be the consumer names, which we've been talking of, that I think consumer names are more near the bottom, and to that extent, they should be accumulated now. And they always tend to outperform in a risk off mode in any case. And then the overall capex industrial cycle, growth cycle in India is still there. And to that extent, that cycle, although has slowed down, but it still should be there for the next few years. And there also we are seeing valuation correction in many companies. So I think that's where we should be looking to buy. And the last space, obviously, are the financials, where if the asset quality holds up in as the quarterly results come out, then many of the financials do look reasonably valued.
Apex and financials is a theme that you can be watching out for, and given the correction, doesn't seem like it's just the end of the bull market that we have seen at this point in time. Feels like it's a healthy correction. That's the take coming in from Sandeep. But yesterday, all eyes will be on HCL Tech because just after TCS, the hopes are high from the IT pack. But what to expect from TCS earnings? Let's try and find an answer to that. And Anisha is joining us to give us what is the street penciling in with HCL Tech. Anisha.
Well, after TCS, all eyes will be on HCL Tech, and it's as it is a seasonally strong quarter for HCL Tech, so the expectations have become all the more. As it is, we are expecting a constant currency growth of almost 4.5%, a dollar revenue jump up of around 3.3%, so that the number comes closer to $3,560 million. The rupee revenue is also expected to shoot up by around 30,050 crore. The EBIT margin is also expected to substantially jump by almost 80 basis points. The wage hike impact that the company is expected to take this quarter will be offset by the strong performance that we're expecting in the product business, and that's the reason we are expecting the profit jump up by around 10%. Overall, if you look at the services business, it's expected to grow organically by 1.7%, and also the Comtech acquisition is something that is going to give a bump up to the revenue. Almost 0.5% contribution is what we're expecting from that. Deal bookings are largely expected on similar lines what we saw in the last quarter. If I have it right, deal bookings last quarter between $2 to $2.5 billion. That's the range that we're expecting this time. The street is already pricing in a guidance upgrade, so the guidance is expected to be revised upwards to 4.5 to 5.25% from the earlier 3.5 to 5%. So that's something to watch out for. Of course, we have a new CFO on board, so that will be interesting to hear out their commentary. But overall, expecting a positive set of numbers from HCL Tech given the seasonal uptick as well.
Okay, that's that on HCL Tech. But Sandeep, what is it that you've made of Avenue Supermart's earnings? I mean, it's a mixed bag from brokerages. Some continue to hold their outperform rating. Some have cut the price targets as well. But having said that, they've missed the earnings estimate pretty much on all count. And then there is that management rejig as well. Neville Noronha steps down after almost a decade. And it's Anshul Asawa who's going to be taking over, although Neville stays put for another 1 year.
So I think the company is facing a challenging phase after a very aggressive growth for nearly a decade. So last 2-3 years, if you see earnings growth is hardly 5-6%. Last year earnings growth was 5-6%. This year they'll end up with a 5-6% earnings growth. Next year, most analysts expecting it to revive to 12 to 15%. So in that context, the valuations of the company obviously are excessive, because even if we take most aggressive estimates for next year, it still trades at between 75 to 80 times earnings. For a company which is not going to grow at the 30-35%, a lot of analysts had built in that they will continue to grow at a trend rate because they'll take a lot of market share, etc. Now it's moving in the reverse direction, where they are facing market share issues from quick commerce operators, etc., and they're been slow to adapt to technology. So I would think that there's more downside than upside in the company. When the initial sales number had come out, those seemed encouraging, but it clearly is visible now that the sales numbers were achieved at a significant cost to the margins. And to that extent, the valuations no longer remain attractive. So I would think that we will still see a prolonged phase of valuation correction in Avenue Supermarket.
The other gaming part in the market is that what is happening in the IPO market. Buy in the pre-IPO, apply in the IPO, sell on the day of listing, or sell when the lock-in opens. Given how market conditions have deteriorated, do you think this entire gold rush in the IPO market, I won't use the word gold rush, but this madness in the IPO market could come to a stall?
It should come to a stop, and that is also important for to sustain the overall strength of the market, because many of these valuations are coming, IPOs are coming at very, very crazy valuations. Then they get listed, then the price gets ramped up even more. So if you look at many of the IPOs of the last few months, they trade at valuations even now, which are more than 2 times of well-established comparable companies who would have been listed for many years. And even very small companies are getting 50-60 times price earning ratio. And because they get lapped up by anchor investors, and then because the IPO investors have made so much money on the listing cost, so it's an established thing that you just apply in that and you'll make money. But it is not sustainable. I don't think these kind of valuations which are there in the IPOs are sustainable.
Where to your mind in the market right now, the risk is still dawning on us, whether it is valuations or participation or the earnings?
So overall market, given that it's already corrected 11-12% from the top, I would think is reasonably valued, simply given the fact that there is pessimism around earnings growth, policies, both monetary and fiscal, as well as the fact that there is a global fear also now getting built up. So let's see how long it takes for any durable bottom to be made. But I would think that the downside risk from the current levels should not be more than 3 to 4%.
Sandeep, on ITC, on IT, I beg your pardon, what's been the read-through after TCS's numbers? Purely because of the positioning, right? The expectations are so low this quarter, and I guess that's what explains the entire sector moving up on Friday.
Yeah, TCS, I think the key thing which at least I thought was positive was that the comment of the management that discretionary spending seems to be coming back, and their view that under the new administration, the US administration, discretionary spending should now start to pick up further. This is something which was lacking for the last 2 years, and we were actually seeing cuts in discretionary spending. So if this actually plays out and that gets combined with the rupee dollar support which is coming in now, which was also missing for the last 1 year, where till November last year, rupee was down just 1% for the year, while the US dollar index was up nearly 6-7%. So the rupee has also fallen and it's caught on to other emerging market currencies. So that could be helpful, obviously, in the profitability growth of many of these companies.
Just scanning through the markets, and the small cap index last week took a knock of 7%. Now, the small cap index for me is an indicator of market mood and participation. For the year gone by, which is 2024, small cap index was of 25-26%. Nifty was up only 8. And now the small cap index suddenly is down 7%. Chandan, technically, how's the small cap index looking? Only on the charts. Chandan?
Yeah. So looking at a small cap, it has started to witness profit booking from last 8 to 10 trading session. And the concern is that now it is giving a breakdown of last multiple months. If I look at the price setup on the monthly chart, it has been consolidating in a range from last 6 months, and now that support is going to be broken. And I think that may invite the fresh leg of profit booking. So if a small follow-up happens on the negative side, I believe most of the mid-cap, small cap see a corrective move of 10 to 15%. So as of now, the setup and the sentiments are negative, and the price pattern is turning on the lower side in mid-cap and small cap, both indices.
The longest time we've made a case that the store of value is in large cap stocks, and that I think was the most powerful argument for 2024. Yet small and mid cap stocks have done well. But now looking at the way how some of the small and the mid cap stocks, Sandeep, they've turned, can one say that it is time now to really start looking on the other side, which is that if you own small and mid cap stocks, sell them. Swallow that bitter pill, which is take a hit or cut a loss, but move back into large and small cap stocks, because now it's more about capital. It's not about momentum and capital appreciation. It is also about capital preservation. Sandeep.
It depends on what you hold. So if you hold on to companies where you bought in them as part of a speculative move, or you bought very highly valued small cap companies which are not justifiable in any case by any argument in terms of fundamentals, then it makes sense obviously to wind up. And thirdly, if your entire portfolio is just made of small caps, then obviously you run a bigger risk. But if you have a diversified portfolio, and then there are companies in small and mid cap which will also do very well. It's not that they will not do well. So then you wait for some time and actually look to buy them. So I don't think that giving an entire argument where small mid caps are bad, large caps are good, I don't believe that logic holds. Many companies, we've seen over the years, like there are so many companies who multiply in value despite such phases of underperformance.
Let's see what happens into the mid and the small end of the market, because for today the start is not looking that great, but there are a lot of stocks that going to be in focus on the back of the news flow. Let's try find out that list, and Snehi is joining us to tell you all the stocks that will be in focus today. Good morning, Snehis. Take it away.
Good morning, Shrishti. Well, yes, lots of stocks to watch out for in today's trade. First up, keep a close eye on PCBL. It's an earnings candidate. It's a mixed set of numbers coming in because while their revenue is up 21.3% year on year, their PAT has declined 37% and EBITDA margins have also shrunk to 16.3% from 17.3% year over year. Adani Wilmar will be in focus because the promoter Adani Commodities intends to exercise the oversubscription offer when it comes to their offer for sale for an additional 1.5% stake, and now thereby the total aggregate number of offer for shares is expected to go up to 19.5 crore. And offer to non-retail investors has also seen 111.2% demand on day one at an indicative price of 276.51 rupees per share. So watch out for this stock as well. Keep a close eye on Vodafone Idea as well because the company has allotted a little more than 169 crore shares at 11.28 rupees per share to its promoters Omega Telecom Holdings as well as Usha Martin Telematics. And this is aggregating for an amount of 1,910 rupees. HUL will be in focus. The company has incorporated an armed name Quality Walls for the purpose of the demerger of its ice cream business. Watch out for Ola Electric. Now, bad news seems to continue for this stock because they've received a further request of information from the CCPA, which is the Central Consumer Protection Authority, and this follows a previous show cause notice that the company has received from the CCPA as well. Lastly, watch out for Oberoi Realty. Very positive news coming in for this real estate player. The Slum Rehabilitation Authority has appointed the company as a developer for a slum rehabilitation scheme on lands of Mada. And Oberoi Realty anticipates being entitled to a free sale component of roughly 3.2 lakh square feet for the development and the redevelopment of the said land. So positive news for Oberoi Realty. But well, yes, keep a close eye on all of these stocks in today's trade.
24 points down for SGX or GIF Nifty, which means we are for a nasty gap down start. And when you see this kind of a gap down start, be rest assured, looking at the frame of the market, what is happening in the global market, how crude has shot up, you're not going to see buyers coming back. I mean, this in a sense shakes the template of where the market has been. So Sandeep, what has changed globally? The general narrative is that crude demand will remain low as world is slowing down. The general narrative was that US has a huge debt, the economy should weaken, the bond yield should come down rather than go up. But what are we staring at? Brent at 80, dollar index at 110, money is moving into dollar. Doesn't that defeat the basic logic?
Yeah, so the initial trends at the beginning of any year tend to follow what happened in the previous year. And to that extent, the dollar strength, the move towards the US dollar before the new presidency starts, and a general risk-off mode has continued. But I think such phases are required for a valuation reset to happen, the frenzy to go out, and people to realize that we need to focus on growth valuation paradigm also. And once that happens, sometimes the policymakers also realize that they need to do things which are economy friendly. And so I think it's glass half full, glass half empty, whichever way you look at it. But I don't actually mind phases of valuation correction because in the long term, it doesn't really matter what happens over a few weeks.
220 points off. So Kunal, it is going to be a nasty gap down start. Is it time to rush in after that?
In terms of buy?
Obviously, selling ke liye kaun aayega?
No, I don't think so, Nikunj, because it makes a lot of sense to try and stay out over here because this would be the first day where we'll get a confirmation of the Nifty breaking below the 23,250 mark, 260 mark, which was the November low for the index. We've already broken below the bank Nifty lows previously, and that's why I think over the last 4-5 days we saw a more higher paced sell-off in the banking index when it managed to break below the previous lows of the month of November, and also with the break of the 200 moving average for the bank Nifty. So which means that we are in the construct of the market where a break of the previous low and a confirmation of a close below that level generally leads to more of an a slight increase in the acceleration or the pace of the correction. So if that's the case, for the benchmark indices. I think, and if we close below this 23,250 mark thereabouts on the spot levels, then I think we could be in for some bit of more pressure. So I would want to be more of a wait and watch.
Sandeep, now the way you invest is that buy the panic. But is it too early to say buy the panic is looking attractive?
So I think we'll have to go stock by stock, whether because the Indian markets have been correcting for a longer time than many of the other markets also. And on an overall basis, I think the sentiments are quite circumspect, negative. Expectations from the budget are almost zero or two negative. Otherwise, what usually happens that people start building in some positive expectations from the budget, etc. So let's see. I would think that we could see a bottoming phase coming in much faster than what most people expect. But let's wait out for the next week or so and see how things stabilize both in India and globally.